Hello investors, my name is Gary Luna. This is Grant Haddon. Adam Carlini is also with us. We are Dynamic Wealth Management. Today is Friday, June 9th, and we're happy to bring another video to you, giving you an update on what's going on out there. Summer months are upon us, about 105 here in Surprise, so it's getting warm. We're hoping everybody is having a good and safe vacation wherever they're at. Hopefully a little bit cooler weather. But we had some news in the market today, didn't we?
We did. So the market has been going up for a long time, and we like that. We like to see that. Well, that being said, market today in the NASDAQ and some of the technology sectors took a big hit. So we're going to talk about why that was, what happened out there, and what we see happening going forward. So let's jump into the charts and we'll show you what we're talking about.
It is great to be with you here on this Friday, June 9th. And let's go ahead and jump into things. First of all, we want to remind everybody that we're taking a break for the summer from our formal events that we give as far as seminars and our investments for breakfast, which are done here in the office. But we are still working throughout the summer, so we don't want you to think we're not. So we'd love to meet with you. If you're in town and would like to come by and see us, give us a call at 623-466-6060, and we can sit down and go over your personal financial situation. Let's talk about a few economic reports that we thought were significant that happened over the last week or so. This is the weekly update that we get from TD Ameritrade, and they point out three key things. First of all, we had a jobs report that was fairly weak, which we'll get into here in a second. Also, we had a growth report that came out, and that's one of the Federal Reserve's preferred growth reports that showed some slowing for the month of April, and we'll talk about that, as well as weak inflation overall as far as pricing is concerned. And we do believe that the Fed will probably move forward with an interest rate hike this next week on Wednesday, to be specific. So first of all, let's talk about that jobs report. Here is your graphic of what the job situation has looked like over the last so many years. And basically what the jobs report came out at, it was about 138,000 brand new jobs were created. Although that sounds pretty good, that was about 50,000 less than what they expected. Not only that, but they also revised April and March downward as well, and as a net of about 66,000. So basically that was not a good jobs report. Now the unemployment rate did go down to 4.3, as you can see there. But overall, that was a fairly anemic jobs report as compared to what we've had in the past. We do not anticipate that that is a brand new trend, because jobs have been fairly strong. But that is definitely something to be watched, and obviously jobs and people employed move the economy. As you know, 2/3 of the GDP is made up of consumer spending, and so we'll have to wait and see how that continues to pan out, but something to be watched. The other thing that was interesting over the last week or so was inflation numbers that came in, and basically inflation slipped. Prices overall, excluding volatile food and energy, managed only about a 0.2% monthly gain. And so the year-over-year number slipped to about 1.5%. And as you can see, this is a comment that came out from Econoday, which is one of the websites that we use for this type of information. They're saying this is the lowest rate since December of 2015. So this is a somewhat subdued number as far as inflation is concerned. You'll remember that the Fed has really two mandates. One is job growth, which we just talked about, and the second is inflation. So will this be enough to keep the Fed from raising short-term rates this next Wednesday? Well, let's take a look at our graphic for that. So this is reported. You can go on to CMEgroup.com, and they have a probability chart. So they use futures, buying and selling, and basically the probability of a Fed increase is now at about 93%. So basically the markets are pricing in pretty high rate there, that we will have a short-term increase, probably of about a quarter point next Wednesday when we get the announcement from the Fed at their June 14th meeting. So expect bank rates to go up a little bit as far as saving rates. Expect maybe credit card rates to go up slightly, maybe car loan rates to go up a little bit slightly. And remember, the Fed is only acting on shorter term rates, so that does not necessarily mean that longer term rates, as far as mortgage rates, will follow suit, and Grant will talk a little bit more about that. But with that, I'll go ahead and turn the time over to Grant, and he'll get into the stock market and talk about the NASDAQ and some things that shook the markets up today.
All right, Gary did a great job of walking us through what's happening in the economy. Let's jump into the stock market and see what's happening. Okay, well today we said we were going to talk about this for just a second here. The NASDAQ actually, so that's the mostly the technology sector, had a big drop today. It fell 1.8%. This is a very big move for the NASDAQ, which has been the best performing major indices. So we'll actually point that out. So you'll notice the NASDAQ, some of the bigger holdings are Google, Microsoft, Apple, Twitter, Netflix. Big names that you know, but they all fell and crashed pretty hard today. So the question is why? Why did that happen? Basically, there's some chatter out there about all of these tech stocks being overvalued, and I'll show you why. They have been running up so strongly for so long. Frankly, they're due for a pullback, and we knew that. We just didn't think it would happen in one day this quickly. But with that being said, we will show you what we're talking about here. So here's the NASDAQ, and this is the NASDAQ all the way back to last July. So we're looking at about a year's worth here. And you'll notice very strong. We had a good little pullback right here, but wow, since then it's just been up, been up, been up, up, all-time highs. And but look at this big red bar today, and that's what we're talking about. So it's been up, 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 up. We've had a couple like that along the way. So and definitely not a reason to run for the hills, but definitely something to pay attention to. So we are watching that. And again, it was kind of, when you see something like this, you see an overvaluation. At some point, some big money is going to start exiting that position. But again, usually it's a short-term situation. It's not a long-term trend. Let's look at stocks, bonds, the dollar, and commodities. So this is over the last 6 months. What is the winner? Stocks by far. Stocks up 8% over the last 6 months. Bonds, fairly flat, but actually recently have picked up 1.46%. We like to see that. It's always good to see kind of bonds and stocks moving in the right direction. For those of you who have a mix, maybe a 60-40 mix or an 80-20 mix, well, you're moving up on both sides, so that's great. The dollar is down and has been coming down really since the beginning of April. With that, interestingly, also commodities coming down as well, which is interesting because usually that's an inverse relationship. And you'll notice here as the dollar fell, commodities went up, but they've actually both been coming down, which shows how bad commodities really have been recently. And that's due to energy and oil for the most part. Here's a chart of the major indices. Now remember we talked about the NASDAQ being far ahead of the rest, and really it truly was up over 17% year to date, where the next best was the S&P 500 at 8.5%. So we got about double the return on the NASDAQ. Then again, remember that's technology over just the S&P 500, which is when most people refer to the market, the overall market, they're talking about the S&P 500 or the Dow Jones. Dow Jones up 7.47%, and the Russell 2000, that's the small cap stocks. They are kind of lagging the pack at 4.9%. So we're definitely watching these. This could be potentially a great time to move a little bit out of the NASDAQ and into the Russell 2000. So we'll pay attention to that, and we'll make some adjustments for our clients moving forward. All right, here's the major asset classes. Again, here's S&P 500 up 9.5. The Dow 8.29. Now again, this is year-to-date numbers. Now small caps, 5.5. International developed, 15%. So international has performed very well actually year-to-date. US dollar down as we showed previously. Commodities down as we showed previously. REITs up a little bit. Interesting, kind of flat on the REITs. High yield and junk bonds actually performing pretty well. So people are interested in yield and taking risk on the bond side. And 10-year treasuries are up a little bit as well, 3.19%. So we like to see that. We like to see people interested in taking some risk. And we like to see the treasuries move up as well, as we do have some treasury positions. Okay, here's the major sectors. And again, they're kind of in order here. Here's the S&P 500 overall, and these are the sectors that make up the S&P 500. Technology, again, up over 19% year to date. Healthcare up 12%. Consumer discretionary, 11.8. Utilities, 11.45. Consumer staples, 10%. Industrials, 9%. Materials, 8.8%. And energy, the big loser, with oil being a big chunk of that and oil pulling back again. Okay, here is a weekly chart of the S&P 500, and what do you notice about this chart? Well, for a long time now, and this is going all the way back to the beginning of 2016, we've been in an uptrend. So that's well over a year, actually pushing a year and a half that we've been in an uptrend. With the nice thing is that for our clients, we've been in a green zone for pretty much this whole ride here. So as this market's ran up, our clients have participated in that, and we took a little bit more risk. We're prepared if this thing turns on us to take some risk off the table and get defensive. But as of now, we're benefiting from the run, and we'll continue to do that as long as it'll give it to us. Interesting, we just want to point out, usually you see a lot more 5% drops than we've seen. Now this is in the S&P 500, but notice every downtick is at least a 5% drop or greater. Notice the last one that we had was actually about this time a year ago. We haven't had a 5% drop for about a year. Very rare. You do see some longer runs in here, but not common to see something run that long. So we're definitely due for a 5% drop. Now here's a chart that's only showing 10% drops. Now look, this is going all the way back to 2009. We've only had 1, 2, 3, 4 10% or greater drops, and the last one being the beginning of 2016. And again, since then, no drops. So we are due. Now, every now and then you do get a longer stretch, so this might continue here, but definitely due for a 5 to 10% drop here. So that would be healthy. We wouldn't panic. You got to know what to expect in the stock market. Real quickly, just the 10-year Treasury yield has been going up. Well, it was, right, since July of last year, but actually this whole year, about the last 6 months, we've been trending down, little by little, trickling down, right? So that's kind of showing us that rates haven't been blasting off like people kind of thought that they would. Something to keep an eye on. Our model allocations. We'll do this quickly. We are still in the green bullish zone. Remember, as long as we're above this yellow line, then we are in the green bullish zone, and we are way into the green bullish zone. We're way up here. So again, when would we get defensive? Well, it would take this ratio to pull back beneath the yellow line, and that would be probably about a 8 or 9% pullback in the stock market at this point before we would get defensive and start protecting our clients. So again, we're watching the market closely. If we start to see that happen, we will get defensive, but as long as it'll run, we will let it run, and we will keep participating to the upside. Again, we're in the green zone, and really the style should probably be down here even a little farther. It is a very green market right here. It's been going up for a long time. What does green mean? It means if you're a growth client in our ETF core model, then you're 100% in, fully participating in all of the growth. If you're a moderate client, you're 80% in, 20% on the defensive side. So participating in 80% of the growth and getting a little bit on the bond side as well. And if you're a conservative client, you're participating in 60% of this growth and 40% on the downside. Now remember, that 40% is going to protect you if we do get that 5 to 10% drop that we're talking about here. You would only participate in 60% of that drop, as well as the bonds should not act exactly as the stock market would. Okay, all right, for those of you who participate in our sector rotation model, now these are our allocations. This is a model that we reallocate each quarter. And these are our allocations as of the second quarter. Now, these will change. We will change the holdings on July 1st. So that being said, there are some of you that get in the middle of a quarter, and your holdings might not exactly match this. But come July 1st, everybody will match again as we reallocate everybody at the same time. Anyway, so we like these holdings. They've been participating with the market, and we've really been happy with the sector rotation model overall. That being said, thank you for watching our video. Remember, for disclosures, we are not making specific recommendations for anyone. We're simply letting you know what's happening out there in the market, and it's up to you to decide what you do or what you talk to your financial professional about. Thank you for watching, and we'll put out another video soon. Have a great weekend.